Today's video, I'm going to break down what is the and asset. I'm going to show you the difference between a typical life insurance policy versus a max funded or overfunded policy. When set up and used properly, I believe it's one of the greatest assets that you can have in your life. And that's why I put majority of all my savings into life insurance because of how it's designed. And so this asset can be truly incredible, and it's not an investment, but it can be an amazing place to put in your portfolio. So I'll let you be the judge of that. I'm going to try to prove this statement, and I know it could be an in-your-face statement, but I really believe when life insurance is set up and used properly, it becomes an asset that can leverage your dollar better than any other paper asset on the market, and that is why I am such a huge fan of this. Now, when not set up and not used properly, I think it's the exact opposite, and that's what I hope to share with you in this video. So this is really the drawing. I've drawn this many times. I'm going to spare you the bad drawing. But when life insurance, again, is funded properly, it literally will give you it will compound your money the rest of your life. I call this lifetime growth or lifetime compounding versus maybe like a retirement compounding. So many retirement plans or strategies don't compound your money till the day that you die, and as a result, you get a fraction, or you're killing the goose that's laying the golden egg. And so I think the lifetime growth is one of those things that is pretty incredible. Now, I also want to be very, very clear. Life insurance is not an investment. If it's ever sold like an investment, you should run. And quite frankly, you will be disappointed if you buy life insurance like an investment. The reason I talk about it being an and is it gives your money multiple utility. And so when I say good growth, I'm really comparing life insurance to a like asset, like a savings account. And so when I say life insurance gets you a 3.5 or 4.5% growth, people are like, well, that's not good. The market or real estate or business grows way more than that. And I 100% agree. That's why I don't think it's a great investment. But what savings account, what safe asset do you know that's getting you anywhere near that? And I have other videos that break this down, but we're not just looking at the 3.5 or 4.5%. We can't just compare that to a savings account, because a savings account you have to pay taxes, whereas a life insurance policy that is tax-free when set up and used properly. And so it really elevates the rate of return even greater. And again, not ever going to compare to an investment, but when you compare all the other benefits, that's why I stand by my statement that when you understand that this is a foundational asset, it gets you a phenomenal rate of return. And that's, again, why I just don't understand why so many people shy away from saying, yeah, life insurance is a horrible rate of return. It's really because they're trying to compare it to an investment, and you can't legally even call it an investment. So lifetime growth, sorry for getting so passionate about that. Lifetime growth is a benefit. The other epiphany that I had is you can control and use your capital today and in the future while your money continues to grow. This is why I wrote the book, The And Asset, because I was so blown away that you can use your capital to invest in things that you care about, your business, real estate, whatever, crypto, the market, and you get the future compounding benefit regardless if you've borrowed against it or not. That's truly incredible, and that's just an amazing benefit that we have in life insurance. At the same time, the life insurance as a part of your portfolio in the future gives your dollars multiple utility and multiple options. So if you have money in the market, it gives you the ability to potentially take out more cash flow, because the life insurance can be a non-correlated asset that can become a volatility buffer, meaning if there's volatility and the market's down, you can tap into that and let your assets recover, and as a result, be able to take out more money, because it's just one of those things where the 4% rule or the 3% rule is really there as a hedge for volatility. But if you're able to take 4, 5, 6 years of volatility off the table, you're able to withdraw more money with confidence. It also allows you to be more creative with pensions and unlock other assets. Point is, when life insurance is a part of your portfolio, you can get out more cash flow. There's a lot of academic research, including Ernst & Young just did a study on this, and it just shows you that it's not in the rate of return, it's in where your assets are held and how they can spend money in the future. And so I've talked about retirement should be really called future cash flow planning, and if we called it future cash flow planning, we would become bigger fans of things like life insurance, because we would understand life insurance as a part of your portfolio could enhance the cash flow of what you can spend, which is an amazing benefit, and what retirement I think should all be about is how much money you can spend. At the same time, when life insurance is set up and used properly, it protects you and your money through the death benefit, through other living benefits and other riders that the insurance has. This is something that majority of people will agree with. And so it's just, again, you put $1 and it gives you 4 jobs and 4 utilities or benefits. And then these are the other 2 is the ability to save more. Again, there's no academic research that backs this up. I just reverse engineer and say, can I save more money as an entrepreneur if I have access to it throughout my life? For me, the answer is yes. I know if I had to choose between this or that, my business or a Roth IRA, my business or a 401k, it would be like this, wherever I put my money, there's an opportunity cost, short-term and long-term. I know since I have control over it, I can save a lot more. Okay, so that's just maybe my opinion. You can let me know in the comments. Do you agree with that? Do you disagree with that? But I just believe, and I've seen our clients be able to save more money because they're not saying see ya for the next 10, 20, 30, 40 years. And then the most woo-wee thing I might say all day is I believe it makes you be a greater asset if you understand life insurance. I believe you can live more intentionally if you actually understand the multi-use of life insurance. So again, take this with a grain of salt, but I believe if you understand life insurance and it's at your portfolio, it unlocks you to live more intentionally. Again, I understand that that's not really backed up in a lot of numbers. It's mostly, again, my experience in working and coaching with people. So what is life insurance? Life insurance is a contract between you and an insurance company. It's a unilateral contract, which means if you do what you say you're going to do in the contract, the insurance company is binded to do what's in the contract from day one. And so you're really in control because at any time you can not do what you're gonna do and walk away, but the insurance company is bound to that contract. So really, the first thing is if you're gonna make a contract with anything, you have to understand what is the credibility, how powerful is the insurance company's ability to keep their promises. And so there, you have to understand the difference between a mutual and a stock company, the ratings, and just is this company new, or have they been around for over 100 years? Which majority of the insurance companies that we work with have been around for over 100 years, which just creates a little bit more credibility than the bank or credit union that it just pops up. There's a lot of credibility there. We get questions a lot about the mutual versus stock. Mutual pretty much means the policyholder, the person that's entering into the contract, is part owners of the insurance company, whereas a stock company, in my opinion, has this conflict of interest because the profits go to the shareholders and they also need to create competitive products. And so the dollars are really, there's a fight who gets them. Whereas a mutual company, the benefits, the profits ultimately flow to the policyholder. And so I don't think I've ever sold a stock company, maybe like a couple term policies when I first got in the business. But every and asset / overfunded life insurance policy that we've set up has been with a mutual carrier that's top rated, that has a long track record. And it's just really, really important that you want to set it up in that way. The contract. Not all contracts are created equal. And this is what I really want to focus on because yes, the company matters, but I would say the contract in all reality matters more because there's a lot of solid companies out there, but I've seen when I've reviewed so many people's insurance policies is their contract is just not optimally designed, and as a result, they might have a good policy, but it's not great. And so really the contract matters a ton, and there's really a difference between a term and a permanent. This is just like term is a temporary contract that says we're going to protect you for a temper like 20, 30 years. And then after the 10, 20, 30 years, it gets quite expensive. And in most cases, people don't renew because it just doesn't financially make sense. And so term insurance is amazing if you have a temporary need. And I think majority of people, a lot of our clients use term insurance because the way that we set up permanent life insurance is not to maximize your human life value. It's really to optimize your savings. And so if there's a greater human life need, then we get term insurance because that's just the most efficient way to cover or protect you for a period of time. The permanent essentially means it's going to last your entire life. And again, we reverse engineer this to really optimize for cash value and your living benefits. And so when I say a special type of life insurance, the philosophy is we want to maximize living benefits. So we want to give as much living benefits as possible, and we want to minimize the death benefit as much as possible. In other words, we want to maximize cash and minimize the true base or drag insurance costs to each contract. And so again, this is we could spend a whole video on this, but when life insurance again is set up and used properly, when it's max funded, you have safety, you can easily access it. It's easily accessible. So another word to say that is liquid. I believe it gets competitive growth. I'll have another video on this channel. I've have many videos, but I'm going to have another video in this series that talks about the competitive growth. It's leverageable, meaning you can borrow against it and it grows. There's guarantees built in. There's no percentage-based fees. It's free of regulation, and so many other private benefits to life insurance. Depending on what state, some states are really, really good. Some states are average. There's creditor protections. You don't get a deductible contribution, so it's not like a 401k where you get a tax deduction. But when set up and used properly, your money will grow tax-free. You can utilize it tax-free, and it gets passed on to the next generation tax-free through the death benefit. So again, this is not an investment, but it's a pretty remarkable asset if you compare it to a like asset like a savings account. So here's the slide. I'm gonna take myself off here. So this is I'm comparing a typical policy versus a max funded policy. I want to make myself very, very clear. I'm not saying the max funded policy is the most optimally designed. I just want to show you how drastic this can be. This is with the same company. It's a mutual company. This company is incredible. This company is an incredible company to work with, but I just want to show you how drastic how you design a policy and how drastic it could be. So on the left, so over here, we're going to look at you're putting $50,000 in. Now, a common question I get is, Caleb, why are you using $50,000? It could be $5,000. It could be $500,000. I'm just using $50,000 because this is what number we had, and this is just the number that we had. So it doesn't matter how much money we're putting in. This is just for illustrated purposes. This is just to prove a point. You put $50,000 in. The cash value that you have in year one is zero. The death benefit, the permanent death benefit, is $3.9 million. So that's an asset. If you died in year one, your estate would have $3.9 million to get paid. So it's not like you can't say this is a total ripoff, but you can see it's like you put $50,000 into something, you have nothing to show for it year one other than a death benefit. Year two, you put $50,000 in, nothing to show for it. Year three, you're $150,000 in, $25,000 to show for it. So you can see, again, this takes a while to get up. You can see the death benefit is growing because of these dividends are, buying paid up additions. And so again, over time, you could look at this and say, okay, I see where someone would put their money into this, but you can see where Dave Ramsey and many other people are like, wow, life insurance is a horrible investment. It's a terrible place to put your money. No flexibility. It's just really not good. Versus a max funded policy, the same company, you put $50,000 in, you have $39,000. With a way different death benefit, $1.3 million. That's why we're a big fan of term, because if you need a $4 million need, we would get the rest in term insurance, because that's just the most efficient way to utilize your capital. And so again, you put $50,000 in, instead of having nothing to show for it, you have $82,000 to show for it. So it's vastly different. I think this break even is year 6, meaning you have more money than what you put in this example. Again, I'm not saying that this is the most optimally designed policy. I'm just showing you that this is the same company, same person, same health rating, different design. And so a typical policy, again, high base, little to no cash value, no flexibility, and usually takes 10 plus years to break even. This is a typical policy. And again, I'm not endorsing this. I'm not saying that this is a great policy. This is the typical policy. When a lot of people badmouth life insurance, a lot of life insurance is put in this category. And so again, this is a 12-year break even, and which means after 12 years, you have more money than what you've put in. So again, in big picture, when a lot of people are not utilizing their policy at all, it may be fine. I mean, you get a permanent death benefit and you break even after 12 years, and you have different retirement benefits to life insurance. A lot of people say like, this is fine. I understand that. And it's great. But a specially designed policy, usually we have some type of PUA riders or term riders. And really the key thing when you specially design a policy is you have a lot more early cash value, you have more flexibility, you have better long-term growth. Usually the death benefit is also higher when you hit the mortality, when you're actually supposed to quote unquote die. The biggest difference is it pays a way less commission. That's like, I'm telling you, probably the biggest difference is just what the agent gets paid. That's one of the biggest difference. I mean, you could make the argument that there's less flexibility in the future. I have not seen that with the insurance companies that we've written with how we design. Usually it's just you get paid a fraction of what you would get paid in the other solution. That's what I've found. But again, I'm very open-minded, and there's not one design. It's not a one size fits all. But what I find is when you specially design a policy, usually everything gets better, short term and long term. That's what I found. And so in that same company, instead of breaking even in year 12, you break even in year 6. And if you look back, you'll see that the death benefit over 30 years is $5.8 million. That's a permanent death benefit of $5.8 million. Whereas if we go back, this traditional typical policy, that takes 12 years to break even at age 30 is $5.8 million. So maybe slightly higher death benefit, but in a couple of years, the max design policy has a greater death benefit and way more cash value. Instead of $2.7 million, we have 3.2 with practically the same death benefit. So again, short term, better, long term, better growth, more flexibility, higher death benefit long term. The biggest difference is the initial death benefit is a lot smaller, and as a result, more money gets to go towards supercharging all the other living benefits. I will end with this concept of when set up and used properly, your policy, quite frankly, gives your dollars more than one utility. I'll go back to that same drawing. And I think of it like an iPhone, because no one looks at your iPhone or your smartphone and says, this is a horrible investment. No one does that. No one looks at a cell phone and says, that's an investment, that's a terrible investment. Yet it's funny, majority of people have a smartphone. Why? Because a smartphone gives you so much utility. It's so efficient for you to use. And we might hate social media and whatnot, but at the end of the day, it's our GPS, it's our flashlight. We can take calls on it. We can text on it. It's our alarm clock. It's our white sound machine, at least for me. There's so many other benefits. And as a result, it's just one of those things where everyone has. I believe we need to look at life insurance the same way. We should not look at it as an investment. Rather, we should look at it as when set up and used properly, it's an incredible asset. And as a result, it can give us so many benefits and so much utility. And so again, you can make the decision what your opinions are. I would encourage you to share this with people in the industry that need to know this, and maybe people that have a stigma against life insurance. I'm with you. And not all life insurance is created equal. And when you set it up and use it properly, and you understand that it's not an investment, rather it's I think a superior place to store and use your capital. Really, the only cons are in the first couple of years. If you cancel, you have less money to show for it. So that's con number one. Not everyone qualifies health-wise. That's con number two. Those are really the two cons that I see. Because over time, it's a way more efficient place to save and use your money. And so if you want a short-term win, don't do this. If you cancel in the first couple of years, not great. But at the end of the day, if you get a policy that's maximally designed and see it as a place to store your money long-term and utilize it long-term, it can be an amazing asset and can put hundreds of thousands and millions of dollars in the future and give you opportunities and options to create a way greater cash flow in the future. Thank you for subscribing to this channel, sharing these videos. Your comments means the world. We're really trying to unlock intentional living and help people think differently with money. And so hearing from all of you means the world. Take care.